Hello, everybody. Tim Petry, NDSU Extension Livestock Marketing Economist. Today I'm going to visit with you about livestock risk protection insurance. Just a couple of housekeeping details here. One is, you see I'm doing this on November 10th, and so the market changes and things change. So just keep that in mind whenever you're viewing. So let's talk about price risk management tools. There are a number of them, and obviously we've had a very, very volatile market here the last year, but the last couple of years. And there are a number of tools that you can use. People always ask me which is best, and if the market's going to go up, you don't need it. If the market's going to go down, maybe a cash forward contract or futures, depending on, sometimes you need a truckload lot. But if you don't know what the market's going to do, or you need like some floor protection, that's where livestock risk protection really comes in, and that's what we're going to concentrate on today. So LRP insurance is a federal crop insurance product. And the nice thing about it is everything is transparent and known. There are no unknowns, like in the cartoon there. It says that Earl and his insurance agent are having a discussion concerning settlement of his claims. There's none of that with LRP, because everything is known from the beginning to the end, and just another nice thing about it. So what is livestock risk protection? It assures against price declines. It's a single peril policy, similar to a put option, if you know what that is. If you don't, that won't affect us today. The premium is subsidized, and there have been some real important changes there. And actually, USDA has made a number of changes this year that we will discuss that makes it much more usable for producers than it was in the past. It's sold by livestock insurance agents, which are also crop insurance agents, and many of you also have crop insurance, so it'd be the same person there. And a list of approved agents, if you don't have one, is also shown there. So there are livestock risk protection contracts for a number of market classes. For feeder cattle, there's a beef, a dairy, and a Brahman contract for under 600 pounds and 600 to 900 pounds. We're just going to concentrate on the beef one today. And for beef contracts, there's also a heifer contract. So there's a under 600 beef steer, or a separate heifer contract, and for the 600 to 900 pounds of beef steer and heifer contract. And we're just going to talk only about the 600 to 900 pound beef steers today. It's really too late to get an LRP for the lighter weight calves, and we're into February, so we'll do that. Also a fed cattle contract that we won't talk about. So livestock risk protection for feeder cattle is based on the Chicago Mercantile Exchange Feeder Cattle Price Index, shown at the website there. The CME has this index for all 7 to 899 weight medium and large 1 and 2 feeder steers at markets reported by USDA, and actually in North Dakota, that's Napoleon, Mandan, and Dickinson markets are included, as well as Montana, South Dakota, all the way to Texas and around where feeder cattle are sold. The CME just comes up with one price for those cattle, one price a day, called the CME index, and that's what the futures market is settled out to when it matures. And it's all transparent. There's a spreadsheet on their website that shows all the markets for that day, the prices and so on, and then the one price. So here's the January feeder cattle futures and the CME feeder cattle index to show you how they compare. Sometimes the futures are above and sometimes below, but we just know here for the January contract, the last Thursday in January, they will be the same. And the other big thing we want to visit with you about here today is the volatility in the market. Starting in March of this year, you see we were up there at 148, and then COVID hit and we abruptly declined to about 114, and then we inched back, and by mid-August we were back up to 147 or so, and then a bunch of issues, drought and so on hit, and a storm in Iowa, and other issues as well as corn prices going up. Very dry in the winter wheat belt, and so there wasn't demand for winter wheat cattle, and fed cattle market struggling. So the feeder cattle futures again went down to about 124, but now came back up to about 141. So you see all the volatility there. Think if you had calves to sell in mid-October, you'd have wished you'd had some price protection. For sure, if you had backgrounded calves in March and April, it would have been nice to have some protection. So LRP does offer that. LRP policies may be available for the following weekly lengths. It's always 13 weeks is the closest one you get, which now puts us out to February, and then the 17-week is March, and so on. The policy that was offered last night and this morning, again, I'm doing this on the 10th of November, only offered through 39 weeks, which is out to August. Now, the one that comes out later on today, again, maybe offer more or less than that. Every day may be different. The real advantage of LRP is the policy size. Again, the feeder cattle futures market and options is a 50,000 pound contract. Well, here you can do one steer up to a maximum of 6,000 head per policy, or 12,000 years. So I think that would fit most. We can do one 4-H steer, or for you smaller producers, if you just want to learn, do 2 or 3 at a time if you want to, or 5, or whatever that might be. That's the beauty. You set the policy size rather than the futures market where it's set for you. So the coverage prices and rates and so on change daily and are at the RMA website shown there, range from coverage levels of 70 to 100% of the expected price. And we'll get to that in a minute, but this is really important. On September 14th, in effect, a couple times here in the last year, USDA has raised the subsidy rates. For many years, it was 15%, and some producers didn't think that was enough of a subsidy, and premiums are too high. But as of September 14th, here are the new subsidy rates for the 95 to 100 coverage level 35, and then the subsidies go up, as you can see there, as the coverage levels go down. And so we'll just look at some actual examples here in a minute. So this morning, this is what, or yesterday afternoon, this is what would have shown on the screen for over 600 pound feeder steers. I mean, you just have to click in a couple things, your state, and then when you go over there on the top where it says type, steers weight 2 are the over 600, steers weight 1 are the under 600 pounds. Again, this report was on November 9th, so when you're reading this later on, possibly in a couple weeks, there will be new prices. The expected ended value was 140.45, and that corresponds, as you see in the green towards the bottom. Yesterday, 9th feeder cattle futures closed at 140.72, and so that's right on the expected ending value. The price, highest price USDA offered was 138.50, and the premium that the insurance agent would get would be $5.18, but your out of pocket would be $3.37 because of the 35% subsidy, or going down at, 136.50 at 280, 134.50 at 231. Then when you get below 95% coverage, it increases to 40% subsidy. So how do you do it? Well, you have to submit an eligibility application with your insurance agent. Probably most of you have done that already if you have crop insurance, and the insurance agent just submits this electronically, and then you select a policy. It's available after 3 o'clock every day, maybe usually closer to 4 o'clock. So you just say the number ahead you want to do, that policy length, the 13th, 17th, whatever closest to the actual date you're going to market the cattle. You have an estimated market weight that you have to give them. Maybe it's 750 pounds or whatever. Your cattle don't actually have to weigh that. Maybe some weigh 650 and some weigh 850, but you tell them the market weight. That's what you pay the subsidy on, and that's what you're paid out on the end if you in fact do receive a payment. Then you choose which coverage level you want. We used to have to pay the premiums up front, but again, a recent change there is now you don't have to pay until the contract matures, similar to crop insurance. So that's been an improvement as well. And then, you have to do this between 4 o'clock and 9 o'clock the next morning Central Time, kind of unusual hours there. So finish up here, the advantages of LRP are that you can do small numbers, both above and below 600-pound steers and heifers, unlike the futures market, which is just a over 600-pound steer contract. The premium is subsidized, no brokerage or margin like in futures. If the market goes up, fine, you sell your cattle for a higher price, and after all, we don't buy insurance usually expecting to pay as well. And all the coverage prices are available every day if they're on the website. Disadvantages, of course, probably is it's not flexible like futures and options, where you can get out of those contracts, buy them back if you want to. You must keep this till that one maturity date, and you must own the livestock in order to buy an LRP contract. Exception is for calves that haven't been born yet. You could still do that even though they're not born yet. So that's a very quick thing. I do have on my website another about a half an hour talk on feeder cattle. It's a voiceover and some more information. And if you want even more information, have your extension agent or your farm business management instructor possibly set up a meeting to find out more.